Hello everyone, I hope you guys are doing well and your studies are going in full swing. Now in today's video, we are going to discuss about one of the most dreaded topics in your CA final AFM in your foreign exchange chapter, which is on the fate of forwards. This will include all the aspects, that is cancellation, extension, early delivery and even the dreaded late cancellation. So what we are doing over here is we are going to discuss the concepts for each of them. We are going to do the steps that you need to remember and the most important question for each of these areas. So basically, if you just listen to this, let us say 1 hour video with the sums, beyond this you don't need to worry about fate of forwards. That is more than sufficient, because if something comes in the exam, it will be relating to this part only. So because it is so important, we have tried to do a separate video separate from our regular forex revision video, because this on its own requires a bit more detailed discussion as compared to a general video. So before we start, in case you have not subscribed, please do subscribe to our channel, and in case you like such content, please press the like button for this video, and I hope you have done that so that we can start with this all important video. Okay, so let us start. First of all, what do you mean by the fate of forwards? Now, a forward contract is a one-to-one over-the-counter contract between the entity and let us say a forex dealer or a banker as a case. Maybe this contract, unlike a futures contract, is not listed on the exchange, and hence the drawback of a forward contract is it remains illiquid. Which means that if I've entered into a contract, let's say I'm an importer who has to pay $1,000 after 6 months, and if for some reason after let us say 2 months I need to cancel the contract, I cannot do that because I can't really sell it or offset it on an exchange, and hence I will have to take certain steps. So what are those steps? In case let us say your underlying deal, like your import deal, there is some change. Let us say you don't have to pay under the import because the goods are defective, or you have to pay a little later where you want an extension, or let us say you have to pay early for some reason and you want an early delivery, or whatever is the reason. All of those aspects, how do you handle in a forward contract, is what we are going to discuss over here. So the first aspect that we discuss over here pertains to something called as cancellation. When we look at a cancellation means the contract that you have originally taken. Let us say you have taken $1,000 forward buy as an importer at the rate ₹80 per dollar. So 80 rupees is your cost price because you have agreed to buy. Now how do I cancel it? Well, let us say your contract was maturing on 31st of March and on 1st of March we want to cancel this contract. That is 1 month before maturity, we want to cancel this contract. So the banker is not agreeing to cancel. So what we will do is, well, you know what, if you had agreed to buy initially, you will cancel it by selling it, and hence you will take the offsetting opposite position. A buy contract will be cancelled by sell for the balance and expired period. Let us say you're on 1st March and you want to cancel this, in which case you will take a forward sale contract for $1,000 for a period of 1 month, and the difference between these two rates will be your gain or loss on cancellation. So summary level, this is how you calculate the gain or loss on cancellation. Now when we want to cancel, sometimes you might want to cancel before the due date, like in our example, or you might even want to cancel on the due date. Let us say come 31st March, you realize that you don't want these dollars, but you have already entered into the forward deal, in which case you will cancel on the due date, but you will cancel again by taking the offsetting position, that is sell, but there is no balance and expired period, so you will do a spot sell, and the difference will be gain or loss. So basically, if you want to handle any cancellation questions, generally we will remember 5 basic points, and if you kind of remember that, most likely you will be able to solve the question very easily. Step number 1, you will think, your thought process will be from the customer's point of view, that is from the importer/exporter's point of view, not from the bank's point of view. So you will see that what are the actions that I, as a customer who want to cancel, will I take. So first of all, be clear that you are thinking from the customer's point of view. Secondly, you will note down the original position. Like for example, you will say that originally forward buy $1,000, let's say after 6 months at the rate ₹80 per dollar. Okay, if you are buying, it is like the cost price. If you are selling, it is like the selling price. Third, you will try to take the opposite position. So if you have originally agreed to buy, you will cancel it by selling it. So sell for the balance and expired period. So you will mention the cancellation position, that is, let's say forward sale or a spot sale of $1,000 at the rate, whatever is the rate per dollar. Now, while you want to find the cancellation rate, if the rate is directly apparent from the question, you will take that. However, there may be certain complexities where you might sometimes have to find the cross rate, or there may be some exchange margin which may be added or deducted, and hence in case some calculations are to be done, in step number 4 you will calculate the cancellation rate. Once you have found the cancellation rate, you will find the gain or loss on cancellation as, let us say, the selling price minus the cost price. Let's say the cancellation rate is 82 rupees per dollar, in which case 82 minus 80 into $1,000, this will be your gain or loss on cancellation. Remember, this gain or loss on cancellation may be fixed today, let's say on 1st March. However, it will actually materialize when the contract was due to expire. So theoretically what will happen is, on 31st March, you will buy the $1,000 under the original contract, pay 80, that is 80,000 rupees, and that $1,000 that you get will sell at 82 rupees and get 82,000, and hence 2,000 will be the gain or loss, which will happen, for example, after 1 month. However, physically it is not necessary that these deals actually happen. If you have done it with the same bank, it will be offset and a net gain or loss of 2,000 will be materialized, let us say, on 31st of March. So that is on cancellation. Second is extension. When you look at extension, extension is kind of just a step above cancellation. Like for example, you are on 1st March and your original forward contract was due on 31st March. Now for whatever reasons with your supplier, let's say you get some more time to pay, and as a result over here, the payment is now likely to happen on 30th of April. You go to the bank and you say that this deal that we had entered for 31st March, I want it for 30th April. Well, the banker says, I am not going to touch on this deal. What we have done is we have done. So we say that then how do you get this extension? Well, over here, you will cancel the existing contract because you don't need anything on 31st March anymore. Cancellation will happen in exactly the same way as we discussed earlier. So your original contract stands cancelled. However, you want a new deal and hence you want to enter into a new forward contract on 1st March. Let us say for a 2-month period. So you will have a forward buy of $1,000 at whatever is the prevailing rate for the 2-month period, that is extension. So extension will have a hidden cancellation plus a new contract. So when we look at extension, extension can be demanded before the due date, in which case cancellation will be by the offsetting reverse forward rate for the balance unexpired period, or cancellation can be demanded on the due date, in which case extension, if demanded on due date, will be by cancellation of the offsetting spot contract. So the existing contract gets cancelled and you will take the new contract. So that is extension, which can be done before expiry or at expiry. Basically the steps will remain the same as cancellation, plus over here you will have a 6th step for the new forward contract at the prevailing rate. Now these two take care of your cancellation and extension. Before you proceed on into the other two aspects, I would want you to try a couple of questions on this so that we are comfortable. So these are two very important questions, I would say, within the cancellation section. We do multiple sums, but this is the most important one, so I'm discussing that. Even extension, we do multiple sums, we will discuss the most important one, so that is more than sufficient. These 4 questions for 4 topics and you are good to go. A bank enters into a forward purchase. TT is like a telegraphic transfer. A bank enters. Be very careful. Remember, we think from the customer's point of view. So if the bank is doing a forward purchase, that means the customer is actually selling. So if the bank is purchasing, we can say that the customer would have originally entered into a forward sale contract covering an export bill of Swiss franc 1 lakh at 32.4. So your original position from the customer's point of view. So if I were to look at this, in question number 51, your original position from the customer's point of view would be customer has entered into a forward sale. No question says buy, but that is bank is buying, so customer is selling. Forward sale of Swiss franc 1 lakh at the rate 32.4 per Swiss franc. Customer is selling, so the price is the selling price. And on 25th of April and covered itself for the same delivery in the local interbank market at 32.42. Okay, now the bank has agreed to sell to the customer at 32.4. Bank has agreed to purchase from the customer at 32.4, and maybe in the interbank market, bank has done some other deal at 32.42. Now that does not really matter to the customer. Whether the bank is covering it, does not covering it, does not really matter. Okay. However, on 25th March, well, that is 1 month before maturity, the exporter sought cancellation of the contract as the tenor of the bill has changed. In the Singapore market, the Swiss francs are quoted against the dollar as under. So this is Swiss francs, that is CHF, per US dollar. These are the rates, spot rate and 1 month forward rate. There's 2 months and 3 months as well. This is a lot of data. And in the interbank market, US dollars were quoted as. So this is rupees per dollar rate. Again, spot. This is spot April, May and June. This is the way interbank rates are quoted. Spot April would mean the expected forward rate quoted in the interbank market for April, similar for May, similarly for June. Calculate cancellation charges payable by customer if exchange margin required by the bank is 0.1% on both buying and selling. The exchange margin is to be adjusted in the rupee per dollar rate only. If this was not given, then you can even adjust it in the final rate. Your answer will remain the same. So over here, first of all, you will take the original position from the customer's point of view. That is a forward sale, which means if you're cancelling, well, you're cancelling 1 month before the due date. So you will cancel by the opposite position, that is forward buy. Again, what forward buy? 1 lakh CHF at the rate. Well, some rupees per CHF. If I look at this, well, I don't have rupees per CHF, which means I'll need to find a cross rate. So once I write the cancellation deal, I would say cancel by forward buy CHF 1 lakh at some particular rate. This I will have to calculate. So once I calculate the cross rate, I will ask myself that what is the cross rate I desire? Sir, I desire rupees per Swiss franc rate, which means again, depending on where you have studied, there can be different approaches. Different people address it differently. We usually solve using what is called as a base currency. So what is a base currency? The currency in the denominator of the exchange rate code. We figure out what we want to do with the base currency. So in the base, you have the Swiss franc, which means our strategy should be that today, in order to cancel, what do you want to do as a customer for the Swiss franc? You will say that, well, you want to enter into a forward buy contract for the Swiss franc, which means the banker over here is going to sell the Swiss franc, and hence the relevant rate is the rupees per CHF ask rate. So you want rupees per CHF ask, but the question does not give you. There's an intermediate currency dollar, and hence rupees per dollar ask into dollar per Swiss franc ask. So over here, this is a cross rate. Now when you look at the cross rate, you look at the question for rupees per dollar. When I look at rupees per dollar, okay, the rates over here are given in the form of swap points, which means over here, if these points are given in the ascending order, I want the rate after 1 month. Then I will add. If they are given in a descending order, I will deduct. Any rates beyond that are not relevant, and hence this data is given just to throw you off track. So if I take 49.4302, let's say plus 0.41, this is, let's say, 49.8402 and 49.4455 plus 0.42 will come to 49.8655. Now we want rupees per Swiss franc ask. The question has rupees per dollar. Cross rate, we say that if the rate that we want matches with the rate which is given in the question, you want rupee per dollar. Question also gives you rupee per dollar, in which case ask rate is directly 49.8655. There's some exchange margin. The question says exchange margin is to be adjusted in the rupee per dollar rate. We will have to add the exchange margin over here because this is like our cost, and exchange margin will increase our cost. We can add it directly over here, or we can add it in the final rate. Your answer will remain the same, at least in this question. So over here we add it over here. 49.8655 plus 0.1% will increase our cost price, and hence you will add. Achha, secondly, you want dollar per Swiss francs. Question gives you Swiss francs per dollar, and hence you will have to take the inverse. But remember, inverse of the bid rate will give you the ask rate. So over here, the rule that you remember for cross rate is if your rate codes match rupees per dollar, question also gives you rupees per dollar ask rate, to directly take the ask rate. But if the codes don't match, then you have to take the inverse. But the inverse of the bid, the other rate, will give you the ask. You want the 1 month forward. Remember, 2 month data is given to again throw you off track, and hence 1.5150, which means if I divide this 1.5150, I will get my necessary rate at 32.9474. Alternatively, you can directly do 49.8655 divided by 1.5150, whatever rate comes, add 0.1%, you will get exactly the same answer. Okay, so this will be your cancellation rate. Ultimately, your cancellation rate comes to 32.9474. Originally, the contract was to sell. You will cancel it by buying it, and hence 49.9474 is your buying rate, your cost price. Your gain or loss on cancellation will be done as selling price, that is 32.42, minus cost price, that is 32.94. This is per Swiss franc into 1 lakh Swiss francs. 32.4 selling price minus 32.94 cost price into 1 lakh Swiss francs. It comes as negative, and hence this is a loss for the customer, and hence in order for cancellation to be effective, this is the amount that will have to be paid. These are the cancellation charges to be paid by the customer. So this is an interesting question where you have the cross rate, where you have the exchange margin, everything which is there, and hence you will definitely revise this and get done over here. Okay, we have also shown that if you keep it as it is and then ultimately add 0.1%, still the answer remains the same, though the institute has added over here, and hence we have tried to keep the solution in a consistent way. Okay, 52 is fine. We'll go to 53 over here, which is also an LDR question. This is on extension. 51 was on cancellation. An importer requests the bank to extend the forward contract for $20,000, which is due for maturity on 30th October. So if I'm an importer, I must have entered into a forward buy contract. Importer needs to buy the dollars so that they can pay to the supplier, which is maturing on 30th of October for a further period of 3 months. So I need an extension. He agrees to pay the required margin money for such extension. Remember, extension will include cancellation as well as it includes the new contract. So whatever is the margin money will be applicable. It's like the cost will be applicable on the cancellation rate. It will also be applicable on the new forward rate. You have been given the contracted rate. The US dollar is quoted on 30th of October. You have been given the spot rates and 3-month premium 0.87%, 0.93%. This is given as a flat rate. So over here it's given in ascending order, so typically you will add. So if I want to find the 3-month forward rate, it is 41.5 plus 0.87% will come to 41.8611 per dollar and 41.52 plus 0.93%, and hence this will come to 41.9061. So this is regarding the forward rates. Okay, the problem is created because this line, the margin money for buying and the selling rate is 0.075% and 0.2% respectively. Now, this margin money, like in the last question, this was exchange margin, was 0.1% on both buying and selling rate. However, here there's a different margin money for buying rate, that is 0.075%, a different margin money for selling rate, which is 0.2%. Now, this is given from whose perspective? Remember, these charges are quoted by the bank, and hence this charges will be given from bank's point of view. That is the bank buying, is the bank selling, and this will be given from the bank's point of view. Compute the cost to the importer in respect of extension and the rate of the new forward contract. So again over here you have to first solve from the customer's point of view, that is importer's point of view, where the original contract was a forward buy of $20,000 at the rate rupees 42.32, which is a contracted rate per dollar. This was a contract which was expiring on 30th of October, and this, because it is buying, this will be your cost price. How will you cancel it? Well, you will cancel it. Are you cancelling it on the due date or before the due date? Well, you are cancelling it on the due date because you have been given the spot rates on 30th October. So it seems today you are on the due date, which means you will cancel it by, if it's a buy contract, you will cancel it by selling it. But this time around, this will be a spot sell. Again, $20,000 at what rate? Now, here rupees per dollar, the rate which is given to you is the rupee per dollar rate only, and hence you don't need a cross rate. However, there's an exchange margin over here. So how will you solve? Again, you will see that what do you want to do in the spot market? You want to sell. The base currency is dollars. You want to sell. That means a banker wants to buy, and hence the transaction will be at rupees per dollar bid rate. Among the two rates, 41.50 will be the rupees per dollar bid rate. So over here, 41.5 should be your answer. However, rupees 41.5 per dollar is before adjusting exchange margin. Now you have to ask yourself that exchange margin, what do you need to do? Well, this rate is your selling price. This is your selling rate, and hence exchange margin, whatever it is, has to be deducted. It cannot be added because it's like a real estate broker transaction. When you go to buy a flat and there's brokerage, it increases your cost. So you will add the brokerage. But if you go to sell a flat, it will decrease your proceeds, and hence you will deduct. So in a similar way over here, the cancellation rate is a selling rate, and hence from 41.5 you will deduct. Okay, you will deduct. As a customer you are selling, but as a banker they are buying. Remember, the margin money is quoted by the banker, and you will take the buying rate because a banker is buying in this deal at 0.075%, and hence if you do 41.5 minus 0.075% will come to around 41.4689 probably per dollar. So if I were to just verify this over here, you will have cancellation rate is 41.5 minus 0.075%, which will come to around 41.4689. Perfect. And hence, once I find the cancellation rate, I know that my original position was a buy position at 42.32. I square it off by selling it at 41.4689, and hence there will be a gain or loss on cancellation as selling price minus cost price, that is 41.4689 minus 42.32 32, and hence there will be a gain if positive, loss if negative. So there's a 17,022 loss for the importer. So this is the charges or the cost for the importer because I do cancellation. Remember, extension will have a new forward contract that will be at the new rate only. So over here your original position was a buy position. You still want to buy, and you will buy at what? Well, if the base currency is a dollar, as an importer you want to buy, so the banker wants to sell. The banker sells at the ask rate. The ask rate over here we have calculated is 41.9061. So this will be your cost price. However, there is a margin money as well. Margin money will be on the extension, so that is cancellation as well as new forward contract. But this is your buying price, and hence margin money will increase. So you will add. However, you will add what? Well, over here the customer is buying, so the banker is selling. Banker's selling margin money rate is at 0.2%, and hence this will be plus 0.2%. 41.9061 plus 0.2% comes to 41.9899. 41.9899. This is the rate under the new forward contract. So this takes care of the section of extension as well. Now the next part over here is based on early delivery and then going on to the late cancellation. This is as per the specific rules given by the Foreign Exchange Dealers Association of India, that is FEDAI, and hence we will try to solve as per the respective rules. So when we look at the FEDAI rules over here, what is early delivery? In early delivery, the customer is like the importer is coming early to the bank. Let's say the contract was due on 31st March, the importer comes on 1st of March and requests the bank to take the delivery and honor the contract. Remember, there is no cancellation, there is no dishonor of the contract. I'm just saying that whatever was the agreed rate, let us do that just a day before, some period before, let us say in this case a month before. Is the banker mandatorily required to take early delivery? The answer is no. However, if I have a good relationship with my customer, then I would want to honor the commitment and I would say that okay, I will do the early delivery. But while I'm doing that, I have to ensure that I'm fair with respect to the customer as well as with respect to my deal and my profit margin which I was expecting. And hence FEDAI over here requires you to take a few things, which if you do, this kind of takes care of managing the banker's profit margin as well as being transparent to the customer. So what do we have to do? There are a few steps that you'll remember. We'll do this with the numerical so that it is easier for you to understand, but let's explain this. What happens over here is in the first step, you'll kind of prepare a chart where what will happen is if you are the bank at the center, remember, FEDAI charges are from bank's perspective and hence you will think for early delivery as well as for late/automatic cancellation to a great extent from the banker's perspective. So we will say that, well, if I'm a banker, I will honor the existing contract and hence I will make a chart where I will say that under the existing contract, what will I have to do with the customer. However, what happens is, let's say it was a forward buy contract by the bank, where the bank was going to buy. Let's say there was an exporter who was going to give us the dollars. So as a bank, I was going to buy. But I was going to buy on 31st March. Now I'm buying it on 1st of March and hence I will honor the contract on 1st of March. However, what will I do with the dollars that come to me? And hence I will have to take some additional actions. Remember this, I'll have to take some additional actions because the customer came to me early. And hence those additional actions, whatever is the impact due to those additional actions, will have to be recovered from the customer. So this is what FEDAI rule says. So over here, we will try to make a chart where we will figure out that, okay, if there was an exporter who was going to give the dollars to the bank, so bank was going to buy on 31st March, instead they are buying on 1st March at the predetermined rate. Point number one. Point number two, because the bank suddenly has the dollars now on 1st March, what will I do? Well, the bank has to take an additional action where the bank will have to sell the dollars in the spot market. So there will be a spot sell of the dollars in the interbank market where bank is like every other customer. It is going to some other dealers and trying to sell the dollars. So there will be a spot sell. However, conceptually what happens over here is, originally FEDAI has to understand that the banks would have covered the transaction. Like banks would have thought that if I have a transaction with a particular exporter where I'm going to get the dollars on 31st March, bank might have entered into a cover deal to sell those dollars on 31st March. Now, the first deal, original deal is settled, but there is a cover deal as well, which was expiring on 31st March, which is no longer needed, and hence you will have to enter into an opposite position. That is, if you have originally agreed under the cover deal to forward sell, then you will cancel it by forward buy because I don't need the cover deal anymore. So this poses a bit of a challenge. Again, right now it might be a little kind of confusing. We'll do it with numbers and I'm absolutely sure you'll be able to correct this. The problem over here is when I'm looking at all of these transactions, there is so many things. So what we do is in a stepwise format, we will first prepare a chart, then we'll write 3 points. Point number 1, what is under the original deal. Point number 2, what is happening under the spot deal. And then 3, what is happening under the forward deal. While we are doing that, we have to consciously ask ourselves that is this resulting in a cash inflow or a cash outflow today? If yes, you will mention whether it is a cash inflow or a cash outflow, and consciously you have to figure out that whether it is an additional action that the banker had to take because the customer came early. If yes, for that additional action, we'll have to figure out whether that additional action results in a cost or it results in a selling price. Once we are able to do that, then we'll calculate something called as swap charges and we will calculate interest. So over here, there are a lot of these steps, but before going into these steps, we will actually try to do a sum and then come back to the theory and understand what is to be done, because if you do it numerically, it is a lot more easier to kind of understand rather than just splitting out theory facts. So over here, if you go to question number, let us say 56 over here, which is an early delivery question. On 1st of October 2019, Mr. X, who is an exporter, enters into a forward contract with BNP Bank to sell $1 lakh on 31st December 19, that is after 3 months. So the exporter is going to sell the dollar, which means the banker is going to buy the dollars at the rate rupees 70.4. So the banker is going to buy at 70.4 and the bank simultaneously enters into a cover deal at 70.6. Okay, so the bank is thinking that on 31st December from a particular exporter, I will get $1 lakh at the rate 70.4. I've entered into another contract to give that dollars to someone else at 70.6. So maybe 0.2 is my profit margin, just for our knowledge. However, due to the request of the importer, Mr. X received the amount on 20th of November. So this money is received early. Mr. X requested the bank to take the delivery of the remittance on 30th November. So he did not approach on 28th November. He approached on 30th November. That is 1 month away. That is before the due date. The interbank rates on 30th November are as follows. Spot, and there is a 1 month swap points. This is given in descending order. So you will deduct 70.22 minus 0.15. This is 70 point probably 07 and 27, and this is 70.17. Let us say if I had to solve. If the bank agrees to take early delivery, again this was optional, but let's say bank agrees to take, then determine the net inflow to Mr. X, assuming that the prevailing lending rate is 10% and the deposit rate is 1. So we have been told that the exchange rates are to be considered to 2 decimal points and amount to be rounded off to rupees. No paisa shall be involved in the computation of the amount, and assume 365 days in a year, which means we are not going to take the calculation in months, we will do the workings in days. So over here, what is the working that we have to do? Well, the step number 1 over here is typically we try to prepare the chart. That is, we will say that, for example, if there is a BNP bank, what are the deals that have already been agreed? Well, the BNP bank, there's an exporter who's going to sell the dollars. That means BNP bank is going to buy $1 lakh at the agreed rate of 70.4. This is not an additional action. This is an original action which was already agreed, just that it is going to now happen on 30th of November. Now, if the money comes to BNP bank, what will it do? Well, it will sell. So there will be a $1 lakh. It does not need it, so there will be a spot sell of this $1 lakh. Now BNP bank, when it goes to sell in the interbank market, it is now like every other customer, and hence the BNP bank over here will have to, let us say, enter into this contract where BNP bank would say that I will enter into this contract where in the spot market base currency is the dollar. I want to go to sell the dollar, which means in the interbank market, people are buying the dollar. They will buy it at 70.22. So at point number 2, 70.22 will be my spot sell. Now point number 3 is there will be some action in the forward market. Now conceptually, this is a much longer approach. However, a shortcut to this would be, if this is spot sell, there will always be an opposite action, which means this will always be the opposite. That is, this will be a forward what? Buy. Sir, why? Conceptually, originally, what must have happened is BNP bank would have entered into a deal to buy the dollars from the exporter, and hence they would have done a cover deal to sell the dollars. Now that cover deal is no longer required, and hence you will have to cancel it by doing a forward buy. Now that is conceptually the case. However, a simplified approach would always be that if there is a spot sell over here, there will always be a forward buy. Now this is a forward buy, which means in the forward market, well, base currency is a dollar. As BNP Bank, I would want to buy the dollar. So the dealer in the interbank market would want to sell, and hence the transaction will happen at the ask rate, that is 70.17. So this is forward buy at 70.17. So this is your step number 1, where you're preparing the chart. Once you have prepared the chart, like you show this over here in fair, again institute does not do it, but it is advisable if you prepare, so that you know that whether you have to sell, whether you have to buy, at what rate, everything is there. Then the next step is you actually calculate these rupee amounts under point 1, 2 and 3. Point 1, $1 lakh into 70.4, that is 70 lakh 40. Point 2, $1 lakh into 70.22, 70 lakh 22,000. And point 3 will be 1 lakh into 70.14, that is 70 lakh 17,000. Now comes the most crucial angle over here, is where we need to kind of identify whether this is a cash flow today. Like this 1 lakh at 70.4, 70 lakh 40, there is an actual movement of rupees 70 lakh 40 happening out of BNP Bank. It's a cash outflow, but it is not an additional action. This is not because the customer an additional action. This was an originally agreed action, yes, happening at a different point, but this was an originally agreed action. So there's no additional thing that you have to do, but because the customer came early, then BNP Bank had to do a spot sell, which resulted in a cash inflow of 70 lakh 22,000. So you identified that this is a cash inflow. However, this is an additional action. I would not have done it on 30th November had the customer not come, and hence I would say that this is an additional action which is resulting in a sale proceed. So that is a selling price. And a forward buy. Forward buy today is just a position. There is no movement of cash on 30th November, so it's not a cash flow. However, it's a buy, and hence it's a cost position. So we will write down cost price. Once this is done, then as per FEDAI rules, you have to deal with the customer for two things. One is for the swap charges, which is the impact of the additional actions, point 2 and 3, that the bank had to take because the customer came early, and interest, that is largely due to the differences in cash inflows and outflows which are happening, let us say, a month earlier. So over here, first is swap charges. Swap charges will always be the difference between point 2 and 3. Over here, sell minus buy. So you do a spot sell, point 2, and forward buy, point 3. So the difference between the two is a positive 5,000, which means over here, there is a swap gain that the banker is getting of 5,000. This gain will be handed over to the customer, because this is because the customer came early, and hence there is a swap gain of around 5,000 as per the FEDAI rules. However, there is a cash flow today. Remember, all of these movements of cash would have happened on 31st December. Now they are happening on 30th November. So there is a cash outflow of 70 lakh 40, and against that a cash inflow of 70 lakh 22,000, which means the banker had a net cash outflow of 18,000. Now this would have in any case happened maybe a month later, but it is happening now, and hence you will have to recover for interest. So this is 18,000 into, okay, this is a net cash outflow for the bank, and hence the bank will have to borrow this 18,000 if it has to do the transaction today, for which the bank will have to incur interest rate at the rate of 10%. So there will be 18,000 into 10% into 31 by 365, and that will be the interest charges of around 153 that I will recover from the customer. So 5,000 I have to pay to the customer, 153 I have to recover from the customer, and hence the net 4847 is the net amount which is payable to the customer by the bank. Apart from that, as the deal is happening, around 70 lakh 40,000 will be the deal where I will get $1 lakh, pay 70 lakh 40,000, and other than that, by paying another 4847, the transaction gets settled. So this is regarding an early delivery, and if I were to read the theory for this now, this would make a lot more sense. So first step is you kind of make the chart. Second step is you get the 3 points. Original contract, then spot buy or sell, and then forward buy or sell. Over here you identify whether it is a cash inflow or a cash outflow, identify whether it is a selling price or a cost price. Third is swap charges, that is a difference of 2 and 3. If it's positive, that's a gain, negative, it's a loss. And then is interest, the difference of 1 and 2 into the interest rate into days by 365, and that will give you your interest. A quick tip would be that if there's a spot buy in point 2, there will always be a forward sell, and if there's a spot sell, then there will always be a forward buy. So this kind of takes care of the early delivery part, and then you go on into the last and probably the most challenging part, which is pertaining to late or automatic cancellation, that is as per rule 6 of the FEDAI rules. So when it comes to late or automatic cancellation, there is a rule 6 of the FEDAI rules that we need to understand. Now, as per this rule, you have been told that if there is a no-show, which means on the due date, you either come as a customer and honor the contract with the bank, or you kind of mention that you want to cancel the contract. However, if you keep the banker waiting, that is something that FEDAI does not encourage, and hence the banker will wait till the end of the business day in suspense that whether the customer will actually come down and will honor the contract or not. But if you kind of, in your Gen Z language, if you kind of ghost the banker, you don't kind of come in, you don't reply, in which case rule 6 or automatic / late cancellation as per the FEDAI rules gets invoked. Now over here the rule is that the contract will automatically cancel, but the time for which will be taken to be 3 days. Earlier this was 15 days, and hence if you have seen a few old questions of the institute, there might be a time gap of 15 days. Now it remains open for a period of 3 days. And if even beyond 3 days the customer does not show up, the banker can initiate legal proceedings. Now over here there are a lot of small finer points that you need to kind of remember, because this is strictly as per FEDAI rules. There may be some areas where you find logical, some areas where you kind of feel it to be a little illogical, but this is strictly as per the FEDAI rules, and institute questions have come on similar lines, so I would strongly recommend you follow the set pattern. So over here you have been told that as per the amended rule 6 of FEDAI, if the contract remains overdue without instructions, that is a no-show, on or after the due date, it shall automatically be cancelled on latest the 3rd day from the date of the original maturity. So remember, there will be, this will be detected if you see a question where we have done sums where cancellation happens before due date, it happens on the due date, if there's no instruction up to the due date, and if the customer comes later, that is when this clause will get invoked. Now over here there are 3 angles, and for each of them you have to carefully remember. The first angle over here is, what about the original contract? Let us say you are an importer where you had entered into a forward buy contract which was maturing, let us say for simplicity, on 10th of June, and the customer does not show up on 10th of June. What about the original contract? The original contract will be automatically cancelled even if the customer comes after 1, 2, 3 or beyond days. The original contract will be cancelled, and that gain, or I mean that difference due to cancellation, is called as the exchange difference, the amount payable or receivable as the case may be, because the contract has to be cancelled. Now when we do this cancellation, one needs to remember that even if the customer comes on, let's say 11th June, 12th June, 13th June, or even after, the rate that you take for the purpose of cancellation will be the rate on the date when the customer actually comes. So if the customer comes on 11th, that date, on 12th, then that date, on 13th, or even after 13th, then 13th June will be your cutoff rate. So in all of these questions involving late / automatic cancellation, any transaction between the customer and the banker will be done based on the rates prevailing when the customer, as a layman, comes to the banker, let's say on 13 June, then you will take the cancellation based on 13 June. How do I do the cancellation? Well, exactly the same way like I did in earlier cancellation problems. That is, from the customer's point of view, write down the original position and then figure out what is the cancellation position, the offsetting position. So if your original position was a forward buy, you will cancel by selling on the date when the customer turns up. So that will be your position. In case you have to find a cross rate, you take that. Otherwise, if there's an exchange margin, you will show a separate working. Well, if the rate for you as a customer is a buying rate, exchange margin increases your cost. If it is a selling rate, exchange margin reduces your cost, and hence you will find the adjusted rate. Sometimes over here, FEDAI rules require you to round off to the nearest 0.0025. If the question tells you, you'll round it off to the nearest 0.0025. Otherwise, you can keep it as it is. And that will be the contract getting cancelled. This will happen on the actual date of cancellation. So if you look at this, cancellation charges, rule 6 of the FEDAI rules. First is exchange difference. Remember this, you will do from customer's perspective like earlier cancellation problems. This is unique to late cancellation only. It does not happen in early delivery, because in that case the contract is honored, not cancelled. Like cancellation on the actual date of cancellation. The actual date of cancellation is when the customer shows up, let's say 11 June, 12 June, or latest by 13 June. That is the rate that you will take. Remember, this will be solved from the customer's perspective, and this will be the first leg. Over here, sometimes a question might give you exchange margin. In all of these sums, you remember that the exchange margin will be applied on the rates between the banker and the customer. You will do other adjustments as well, like you did for early delivery, like swap charges or interest. This is the rates in the interbank market, and on that exchange margin will not be applicable. Exchange margin will be applicable between the rates between the banker and the customer. Like the cancellation rate, exchange margin will be applicable. We'll do it along with numbers. That will what will give you a bit of clarity. Just hold on for around 5 minutes. So this is the difference between the agreed forward rate and the offsetting spot rate adjusted for exchange margin on the date of actual cancellation. So your original contract is cancelled. However, the banker on 10th, when you do a no-show, would actually have a cover deal. Like for example, if you as an importer would have entered into a forward contract to buy the dollars from the bank on 10th of June, the banker would have entered into another contract whereby they would have bought those dollars, which they can give it to you. Importer is going to buy, so the banker is going to sell. But the banker would have entered into another contract. Now you did a no-show, which means the banker could not give you the dollars. However, under the cover deal, banker has a reputation to maintain. The banker would honor the contract. So over here, there would be a predetermined contract whereby you would have, where the banker would have agreed to, let's say, buy the dollars which they were planning to give to the importer when the importer comes on 10 June. So the banker will have to honor it. So that is point number 1 over here. That is, there is not an additional action. This would have been done irrespective. So this is point number 1. Point number 2, now what will I do with those dollars? I originally thought that I'll give it to my import customer. However, the customer did not turn up, and hence, like early delivery, you will enter into a spot sell. We'll prepare a chart and a diagram that will give you a better understanding, but you will do a spot delivery, like you have received the dollars under the cover contract, which you no longer can give to your import customer because he did not show up. So these dollars that you have received, you will enter into a spot sell at today's rate. This will be on 10th of June, not on 13th June. This will be on 10th June because the banker has to do these transactions in the interbank market on 10th of June only. The customer might turn up on 11, 12, 13 or even later, but the banker has to do all of what he has to do on 10th of June only, and hence the relevant rate over here will be the 10th of June rate. Again, over here exchange margin will not be adjusted. So these are swap charges. You will do a spot sell, but when you look at a spot sell, we will have to do a forward buy as well. Like you did an early delivery, and we do a sum for this. Like if there's a spot sell, the banker will also enter into a forward buy for the nearest maturity. So if it is June, you will take the June maturity. Now, why do I need to do this? Well, that is beyond this. It is there in the FEDAI rules, and hence it is preferable to do it. Though an argument can be that if the customer comes later, for that I will need the dollars, and hence I will take the forward buy. Though from the FEDAI rules perspective, you have to take this. So this spot sell that you have to do in the spot market is because the customer did not come up. So this is an additional action. Further, the forward buy that you had to enter is because the customer did not come up, and hence there is an additional action. So over here, like early delivery, now you will think from the banker's perspective. You will make the chart. Then point number 1 will be the cash flow under the cover deal. Point number 2 will be, let's say, the spot transaction, let's say spot sell, and third will be exactly opposite, that is a forward buy. In this case, all of these transactions will be kind of determined on 10th of June rates only, and there will be no exchange margin adjustment. This is what you need to remember. Now, once you do these same workings, you draw the chart, you do point 1, 2 and 3. Point 1 is the cover deal, point 2 is the spot transaction, point 3 is the forward buy that you will enter. After that, the exact same steps for swap, the difference between 2 and 3, selling price minus cost price. Then is the interest, the difference between 1 and 2, the cash flows into the rate of interest, and maximum for a 3-day time frame. Now over here, one needs to remember that these transactions, FEDAI has only for late automatic cancellation mentioned that this is a one-sided contract, which means if there is a gain, then I will not, as a banker, pass on that gain to the customer. However, if there's a loss, I have all the legal rights to recover the loss from the customer. This is because it is a special penal measure, and this is only and only unique to late automatic cancellation as a special penal measure. Customer has to pay for the loss to the bank. However, the customer is not entitled to the profits, if any, if on either of this interest, exchange difference or swap charges. In case exchange margin is given in the question, it needs to be applied on the cancellation rate, because that is between the bank and the customer, or even the extension rate if it is asked, because it is between the bank and the customer. You will not apply the exchange margin on the interbank rates, like for swap charges or for interest. Exchange margin will not be applicable. This is one thing that you have to remember. Again, you should remember that point 1 will be, let us say, on the 13 June rates. If I were to take similar to the example that you will study, whereas the swap loss or interest will be on the 10th June rates, because in the interbank market you have to deal on 10th of June only. Over here there will be no exchange margin, there will be no exchange margin. However, over here there will be an exchange margin adjustment if that is given to you in the question. So as you can see over here, you will have these spot April, spot July, etc. type of rates, which is usually the interbank terminology for the nearest contract, let's say of forward contract of April, July as a guess maybe. Now there are a few steps over here. The first step is from thinking about cancellation, like the earlier problems. This is from the customer's point of view. So these are usual steps of cancellation of the customer's point of view. That is, find what is the original position, offsetting position. If there's a cancellation rate to be required using cross rate or exchange margin, do that, and then the gain you will not. So this is like, if there's a gain for the customer will not be able to recover it from the banker. Banker does not have to pay. But if there's a loss, the banker can recover it from the customer. Okay, so this is the same working, exchange difference. Then this is very similar to early delivery type of questions. So like when you look at early delivery type of questions, what happens? From early delivery type of questions, what happens? You will first do the transactions from the make a chart, think from the bank's point of view. Then the three usual points that we usually calculate, that is the cover deal, then the spot buy or sell, and the exact opposite will happen in terms of what will happen in the forward. Once you have these 3 pointers, then you will try to take the difference between 2 and 3, that is the swap charges. If there is a gain which the banker earns because the customer, banker will not pass on the gain, but if there's a loss, the loss can be recovered, the difference between 2 and 3, and then there is interest, the difference between 1 and 2. Again, you can recover interest from the customer, but you don't need to pay, and the total of all the charges will be the total of the exchange difference plus the swap charges plus the interest, and that will giving you the total charges, that is exchange difference plus the swap cost plus the interest. Apart from that, depending on what the customer wants on 13th or whenever the customer comes, whether they want an extension or they want execution, whatever, that will be a separate transaction altogether at the then prevailing rates. Okay, so we'll try to address a sum based on this, and hopefully if you kind of get this correct, you should be able to manage. So this is 57. There is another sum in the material as well, but we'll focus on 57, which is on the exact similar lines. So it's a very tricky question. An importer booked a forward contract with the bank on 10th of April for USD 2 lakh due on 10th of June for 64.4. So this is your original contract. The importer will want to forward buy on 10th of April for delivery on 10th of June. So that is 2 months later. The importer wants to enter into, let us say, a forward buy contract for $2 lakh at the rate of rupees 64.4. The bank covered its position in the market at 64.28. So if I think from the banker has to give the dollars to the importer, and hence the banker has to arrange those dollars. The banker will arrange those dollars, for example, at by entering into a forward buy of these dollars in the interbank market at 64.28. This must be done on 10th of April. Okay, the exchange rates in dollar in the interbank market on 10th of June and on 13th of June are. So these are the rates given on 10th or 13th June. So there is a plethora of all of these rates. Spot rate, this means spot today, but then spot in June, July, August, which means this is let us say for end of June, let's say end of July, end of August, September as a case. Maybe you have rates given in bid and ask format. The exchange margin is 0.1% and interest on outlay of funds is 12%. You have not been given for inflow, because if there's an inflow for the banker, interest will be earned, and that interest which is earned will not be passed on to the customer. But if there's an outflow for the banker will have to arrange those funds, banker will have to pay that interest, and they will recover that interest from the customer. The importer requested, okay, this is important, on 13 June for extension of the contract. We did it on 10th of August. They could request for extension, they could request for cancellation, they could request for execution, we don't care. But because they came on 13 June, there was a no show on 10th of June, and hence the rule 6 of FEDAI rules will apply in this particular case. Rates are rounded to 4 decimals in multiples of 0.0025. For the time being, I can say that we can ignore it, just so that you can focus on the question. Though if this is given in the exam, you will round off to the nearest number, nearest 0.0025 number. On 10th of June, bank swaps by selling spot and buying 1 month forward. This is given to you. My point is, even if this was not given, we would have made the chart and we could have found this. You are required to calculate the cancellation rate, amount payable on $2 lakh, swap loss, interest, new contract rate, total cost. So these are the typical 4 or 5 things that will be asked in every question. So what is the first thing? Sir, we will first try to find the exchange difference, that is the amount payable on 2 lakhs. This is done from the customer's point of view, and if I look at the customer's point of view, the original contract from the customer's point of view was a forward buy which was expiring on 10th of June of $2 lakh at the rate customer had entered at 64.4. Now 64.4 customer is buying, so this is like the cost price. Now if I want to cancel it, I would love to cancel it on or before the due date, but the customer did a no-show, and hence the cancellation happens between the bank and the customer on the day when the customer actually comes, that is on 13 June. Remember, a temptation for you over here would be, you would say the contract will automatically cancel on 10th of June. Well, FEDAI over here, in order to make it easier for the customer, FEDAI has said that, well, you know what, customer, when he or she comes, it's just a 2-3 days gap. When you are calculating the charges, show him or her the rate when the customer comes. Ideally, it could have been the 10 June rate, though FEDAI rules require you to take the 13 June rate, that is rated when the customer comes, and hence you will take that. So on 13 June, you will take the spot sell, again $2 lakhs at a particular rate. This is like the selling price for the customer. Now, if I want to find the rate, first of all, I'll take the 13 June rate over here. Now within 13 June, you will take today's spot rate, but there is bid and ask. So you'll ask yourself that the base currency is a dollar. As a customer, I would want to sell the dollars, which means as a banker, they would want to buy the dollars, and hence the transaction will happen at the bid rate. So the relevant rate would be 63.68. So over here, ideally, you would want to cancel at 63.68. Now the problem over here is there is an exchange margin of 0.1%. This is the transaction between the banker and the customer, so exchange margin will be applied. What will you do? Well, because this is a selling price, remember, like a brokerage, exchange margin will reduce the selling price, and if it is like a buying price, exchange margin will increase. So over here, this is reduction of 0.1%, and hence 63.68 minus 0.1% will come to, let us say, 63.6163. Now this is your rate had there been no rounding off. However, if you are told to round off to the nearest, well, this will be 63.6150 if I were to round off. Otherwise, I'll leave it at 63.6175. Sorry, 63 said the closest number is 75 in the multiples of 0.0025. So this would be the rounded off rate. But if that is not the case, then 63.6163 is something that you will take. So over here, if I go to see the solution, your original contract, as we said, was a buying contract of 64.4. You'll sell it at 63.6163. This is, let's say, the selling price for simplicity. And hence, if you want to calculate the gain or loss on cancellation, it is selling price 63.6163 minus 64.4 into $2 lakh, and this will be 1,56,740. This is a loss for the customer. So if the customer loses, it is because the banker gains, and over here, in this case, the banker can recover this gain that the banker has from the customer. It is something, it is notional in nature, I would say. Actually, there is, when you look at a cancellation, it is like the banker doing these charges, that if I had to cancel this existing contract, then what do I have to do? I will see that the customer, when the customer says to cancel, we have a 1,56,000 loss, and hence I have the right to recover this 1,56,000 of loss. This is your cancellation rate of 63.6163. If you round off to 63.6175, there will be a small difference, and there is a 1,56,740 which is payable on this original $2 lakh contract. Now, other than that, is there anything else? Well, yes, we'll have to make a chart. We'll have to say that originally, from the bank's perspective, I had to give the $2 lakh to the importer and get 64.4. However, that deal did not really happen. So this is your deal which did not happen. It got cancelled, and the impact of that cancellation is 1,56,740. So that is done. However, I had another deal where under the cover contract, I was going to take the $2 lakh at around 64.28. So this is not an additional action. This would have happened even if the customer came or did not come. So this is your 0.1, $2 lakh at the rate of 64.28. This is $2 lakh coming in, 64.28, the banker will have to pay. But now what will I have to do? Well, the question tells you, but my point is, even if they did not tell you, what will I do with this $2 lakh that have come in? Well, I will say that I will sell these $2 lakh, and hence there will be a spot sell. Now, if there's a spot sell, an additional action as per FEDAI rules will be, there will be a forward buy, exact opposite, and hence there will be a forward buy to the nearest maturity. Now all of these are happening when, sir? All of these are happening on 10th of June. This is not on 13 June. The transaction between the customer and the banker happens on 13 June, but between the banker and the interbank market, everything will happen on 10th of June, and there will be no exchange margin adjustment. So over here on 10th of June, I am spot selling. If I am spot selling, the dealer is buying, and hence the transaction happens at the bid rate. So over here at 10th of June, the bid rate will be 63.8, and hence this transaction happens, for example, at 63.8. No exchange margin adjustment. Forward buy for the nearest contract. If I am buying, remember, as a banker, I am approaching some other dealer. So I'm like every other customer. If I am buying, the dealer is selling, and dealer sells at the ask rate. So the ask rate over here would be, for example, 63.95. So there is a 63.95 rate. Now you have all of these. So you will try to find the 3 pointers. 2 lakhs into 64.28, that comes to 1,28,56,000. Then you have 2 lakhs into 63.8, that is on spot sell, which comes to, let us say, 1,26,00,000, and then 1,27,00,000. At this point, the most important thing is you have to ask yourself that is this a cash flow? So on 10th of June, is there an actual movement of cash? So in point 1, yes, you are actually going to pay. As you can see over a 64.28, you are going to pay, and hence this will be a cash outflow. However, this is not an additional action. This you would have done irrespective of what is happening everywhere around you. But the second spot sell is an additional action. You are doing it because the customer did not show up. So this is an additional action, which is a spot sell. So it's a selling price. At the same time, when you sell the $2 lakh, you will receive a cash inflow. So there will be a cash inflow as well as the selling price. And lastly, for the third forward buy, again, this is an additional action because the customer did not come. However, on 10th of June, that does not result in any movement of cash, and as there's no cash flow over here, though because it's a forward buy, this is a CP. Now the working will be same. The difference between 2 and 3. So if I look at the difference between 2, which is 1,27,00,000, which is a selling price, and 3, which is 1,27,00,000, which is a buying price. The difference over here is selling price minus buying price, negative 30,000, which means the banker is getting a 30,000 loss, which the banker will recover from the customer. This is swap difference or swap loss. Further, there is interest. That's a difference in cash flows. Difference between 1 and 2. There's a cash outflow of 1,28,00,000 and a cash inflow of 1,27,00,000. And hence, if I take the difference over here, there's a 96,000 net cash outflow at the rate of 12% for a bit of 3 days out of 365. There will be a 95 rupees interest. Again, this is an outflow for the banker, and hence the banker will recover that interest from the customer for a bit of 3 days. And hence, the total what I will recover from the customer is 1,56,740 plus 30,000 plus 95. All of these are costs, and hence you will recover it from the customer 1,86,835. Now this will be your total charges. Apart from that, the question has told you that the customer requests an extension. Now the customer, again, remember, is coming to the bank on 13th of June. So when I look at even the extension rate for the new forward contract, I will have to look at the 13th of June rate. So on 13th of June, let us say what is happening. On 13th of June, you want an extension. Question says with the due date being 10th of August. So for you, the relevant contract will be the August contract, and you will take the 13th June, which means one of these two rates. So how will you calculate one of these two rates? Well, you will ask yourself that what do you want to do? Well, I want to buy the dollars, which means the dealer will sell the dollars. The dealer sells a dollar at the ask rate, that is 64.25. However, in this case, this is a rate between you and the banker, and hence there will be an exchange margin. This is your buying rate of 64.25, and hence if I want to take 64.25 plus 0.1%, and hence this will come to what? 64.25 plus 0.1% will come to around 64.3143. This will be your new contract rate if that is correct. 64.3143, that is right. So this takes care of the new contract. In case there was only cancellation, then the total 1,86,85 you pay and the contract gets settled. Sometimes you might even say that there is an execution. That means they want to do the deal. In that case, you will again do the deal at the spot rate on 13th of June because your original contract stands cancelled. A question might always arise, then why are we having those 3 days? It is just that during those 3 days, there will be no legal proceedings that will be initiated, for example, by the banker on account of this transaction. So this kind of takes care of late cancellation, arguably one of the most challenging sections of this fate of forward section. So I really hope that these 4 questions along with the concepts and steps are clear with you. We'll try to share the relevant PDFs on our Telegram channel as well, the link for which is there in the description, so you can refer that. But at the same time, remember that this is just a particular method. As long as you're getting the same answer using whatever thought processes that you applied, that is fine, as long as you're getting and following the rules properly. Okay, so that should be it for today. I'll see you soon with more videos. Till then, keep studying hard, keep smiling, and have faith in your abilities. Good luck, goodbye, and take care.